Welcome everyone. This is day 4 of our video series, 17 Days of Gen Z and Mortgages. Every generation faces its unique challenges when stepping into the world of home ownership. And Gen Z, for you, amidst rapidly changing landscapes and new financial territories, the golden key to unlock your first home often starts with two words: down payment. A down payment is the upfront money you put towards buying your home. Think of it as an initial investment in your dream property. The rest, that's where your loan kicks in. But here's where it gets interesting. The amount you put down can vary based on the type of loan you choose. But what's the magic number? How much should you save, and how does your down payment interact with the vast realm of mortgages and loans? The journey might seem intricate, but together we'll navigate the nuances, ensuring your footing is firm on the path to owning your own space. Let's dive into a few popular loan types and see how they stack up. First, let's discuss traditional loans, otherwise known as conventional loans. When most people think of traditional loans, the 20% down payment often comes to mind. With 20% down on a $200,000 home, you're looking at upfront payment of $40,000. Now, 20% might feel hefty, but it's a standard that's been around for a while, and it comes with perks. One of the most notable benefits, skipping out on private mortgage insurance or PMI. This is an added cost designed to protect lenders if for some reason you can't make your mortgage payments. But here's a game changer. Some traditional loan programs allow for as little as 3% down. Using our $200,000 house example, that's a down payment of just $6,000. Sounds appealing, right? Especially for those who haven't had years to save up. But this convenience has a catch. That catch is PMI. With less than 20% down, lenders generally want that extra layer of protection. Hence, PMI comes into play. It's an additional monthly fee. The exact cost can vary based on your loan size and down payment amount. So the decision boils down to this. Do you opt for a lower upfront down payment and bear the monthly PMI cost, or do you save a bit longer, aim for the 20%, and sidestep PMI altogether? It's a balance of current financial capability and long-term cost considerations. Your next option that we need to talk about is FHA loans. It's an accessible path with a PMI twist. Let's venture into the realm of FHA loans, designed to bolster home ownership, especially for first-time homebuyers or those without a hefty savings stash. FHA loans are backed by the government. This backing means reduced risk for lenders and more leniency for borrowers. Here's how it translates. If your credit score dances to the tune of 580 or above, you could be looking at a down payment as minimal as 3.5% down. Let's illustrate that. On a $200,000 home, that's a manageable $7,000 up front. But as with many things in life, there's a but. Enter PMI, or private mortgage insurance. Unlike traditional loans, where PMI can be sidestepped with a 20% down, FHA loans have their own version, known as the Mortgage Insurance Premium, or MIP. There's a twofold MIP with FHA loans. First, an upfront cost, typically 1.75% of the loan amount. This can usually be rolled into the loan. Then there's an annual MIP, which is spread across monthly payments. The duration and amount can vary based on factors like loan size, term, and initial down payment. It's essential to grasp this balance. The allure of a smaller down payment comes hand in hand with a commitment to MIP. For many, this trade-off is well worth it, paving a more accessible path to home ownership. Yet, it's all about understanding the full picture, ensuring you make informed decisions that harmonize with your financial symphony. The next loan we need to talk about is a VA loan, a salute to service and a stepping stone to home ownership. VA loans echo the nation's gratitude for the indomitable spirit and sacrifice of our military service members. Tailored for veterans, active duty service members, and certain National Guard and Reserve members, VA loans are more than just a mortgage option. They are a heartfelt thank you from a grateful nation. At the heart of the VA loan is its most compelling feature: no down payment. Imagine stepping into home ownership without the hurdle of saving tens of thousands up front. And the perks don't stop there. VA loans not only waive the down payment, but also boast competitive interest rates, often without the requirement of private mortgage insurance or PMI. This means fewer monthly expenses tethered to your mortgage. Whether you've served overseas or here at home, whether you're a new recruit or a seasoned veteran, VA loans accommodate diverse service histories and financial profiles. However, there are eligibility criteria to consider, rooted in factors like length and type of service. Entrusting you with favorable loan terms is a way for lenders and the nation to reciprocate the trust and commitment you've shown. With the backing of the VA, lenders feel secure, knowing that a portion of the loan is guaranteed by the federal government. The path to owning a piece of land you've sworn to protect becomes smoother with VA loans. It's not just about walls and roofs. It's about building communities, forging connections, and translating service into settled, comforting homes. The last loan we want to talk about today is the USDA loan, Cultivating Dreams in Rural America. When we think of heartland, of the vast stretches of rural America, we picture agriculture, open skies, and the promise of space. USDA loans embrace this vision, aiming to stimulate home ownership and community growth beyond bustling cities. Sponsored by the U.S. Department of Agriculture, these loans are designed primarily for those desiring to settle in eligible rural and some suburban areas. The goal? To cultivate prosperity and sustain communities where roots run deep. One of the USDA loan's standout features is the potential for no down payment. That's right, a pathway to home ownership without the typical upfront cost. This opens doors for many who might find traditional loan requirements daunting. But it's not just about affordability, it's a commitment to revitalizing rural regions, ensuring that these areas remain vibrant, sustainable, and conducive for families to flourish. However, it's not a one-size-fits-all. USDA loans come with specific criteria. There are income limits, which vary by region and household size, ensuring these loan benefits those who need them most. Furthermore, the property itself must meet certain criteria in terms of location and condition. With the USDA standing as the guarantor, lenders are more confident to extend favorable terms. It's a symbiotic relationship, nurturing home ownership dreams while reinforcing the bedrock of rural communities. With USDA loans, the dream of a quiet, spacious sanctuary in this nature becomes attainable. It's a celebration of rural life, where the air is fresher, the stars brighter, and the promise of home ever present. So why does the down payment matter? Well, a larger down payment can mean smaller monthly payments and potentially better interest rates. But if you can't go big initially, don't fret. There are plenty of options tailored to different needs. Whether you're just starting out, have been saving for years, or have served our country. There's a loan type out there for you. Home ownership can be within reach. Gen Z, the world of down payments and mortgages might seem complex, but with the right info and choices, the keys to your dream home are closer than you think. Until next time, keep saving, keep dreaming, and keep building your future one brick, one coin at a time. Join us on day 5, where we will discuss programs for first-time homebuyers. Remember to subscribe or like our page depending on your platform. You can also visit our YouTube channel at Mortgage Knowledge 101 for other mortgage educational videos. I'm your host, John Collins. Thank you for joining us today.